Hello and welcome to UTI Swatantra. We resume after a long break. Hopefully this has been good to you and everyone at home is safe and sound, and if not recovering, then thank you all for joining us this evening. So it's been a very interesting period in the markets. Even as we've been in a lockdown, the markets, as you know, have gone up and then they've come up, mirroring largely what's been happening in many other parts of the world. So some of you as investors might be wondering, what did I lose, and was I wrong in having got out or got in, or did I get in at the wrong time, or did I get out at the wrong time? So these are questions that usually come to mind when markets are very volatile, and it's therefore perhaps apt and opportune that we talk about how to build a winning investment portfolio with equities so as to build a more long-term approach to investing. So I'm obviously not the expert here. I'm joined by two well-known faces and voices. Deepali Sen, founding partner at Srujan Financial Advisors, also a certified financial planner and author of the book Why Greed is Great. I'm also joined by Vishal, Dhawan, founder and CEO of Plan Ahead Wealth Advisors. Thank you both for joining me. So before we start off, Deepali, so what's the last 3 months been like for you, and the way from your vantage point on the markets?
The months have been very interesting. I would only have wanted 30 hours in a day, right from being a maid to a CEO to offering my shoulders for clients to cry on, owing to the market, owing to the debt schemes, and the regular cooking, shooking, and no maids coming in. So I guess like any time, this is a very good time to start building your portfolio. And markets, as we all know, will do their job of being volatile because that's their DNA. We need to do our job of investing as per our goals. So
right. And Vishal, right. And Vishal, for you, how have the last 90 to 100 days been?
So I think there's nothing more apt than saying we live in interesting times. And I think the last 3 months have been, one big journey. I think we've seen volatility that we probably see over, many quarters and years come together in a single quarter. And I think that's been abnormally large. I think it's also meant that the ability for investors to deal with their own emotional space, both as far as their finances as well as their well-being is concerned, has become centerpiece overall. And I think how people have been able to react to this is going to get tested on a longer-term basis as well.
Right. So, and Vishal, when you look back, we're talking about investing in equity funds as an approach. So, why would you say today that this was and is a good approach or a sound approach?
So there are a few, things that we need to keep in mind when we're making allocations to different asset classes, including equity. One is, the very inherent nature of equities as an asset class will be volatility. At some times it's heightened, like we've seen in the recent past. At sometimes it's relatively more stable. But clearly, the ability for equity to behave like a bank deposit exists for very short periods of time. And therefore, I think the mental adjustment that is involved in equities is a big thing, saying that, can we go out and really deal with the volatility that comes with it, and the techniques that can be used to be able to deal with it. The reason why we still need it, in spite of all its volatility, is number one, there are very few asset classes that beat inflation over long periods of time. And I think a lot of times people underestimate the risk of not having enough money to achieve what they want to achieve. And very often that pain is much higher than the pain that you get, by dealing with volatility. So I would say that, that's one very critical reason why equities need to be a part of a portfolio. The second, which is, clearly in there, is that for most individuals, setting up a business is one of their bucket list items. And what equities allow you to do is buy a part of a business set up by someone else and participate in that growth, in that opportunity, in the profits, in the losses, all of that. And as long as you understand that that's a business that you're buying into and you're buying it long term, I think and you have it diversified to, ensure that you don't have too much risk. I think you have very good outcomes with equities if you can control your emotions.
Right. Deepali, how are you seeing? So, firstly, when the markets were, going up and down in a dramatic fashion, particularly in March, April, what were you thinking? And when you look back today, how would you sort of revisit that phase and the whole approach of investing in equities? Okay, Deepali, I think you're on mute.
So sorry. Yeah, you were right, Govind, I was on mute. So for me, I think it didn't take long to acclimatize because I've seen many past extreme highs and lows. So this is universal. This was nothing new. The key was to manage my clients' emotions. So in most of the cases, I would say 90% of cases, I was successful in kind of telling them not to pull out or stop their SIPs. In a couple of cases, they did pull out, but that was for prepaying a huge home loan because there was a sword dangling that they might lose their jobs. So barring that, I think a lot of hand-holding was required. So my days ended up being longer. Besides that, things were logical and sane in terms of staying put and let the tide go down.
Right, and that's an important point. A lot of people obviously have seen, a big change in their professional status, in their businesses, and therefore a sudden need for funds. Now, so when you look back, is it? I mean, did they do the right thing in a way by having invested and stayed invested in the markets, and maybe they're benefiting because of that today?
Yes, you are right. So I think most of them benefited for having a financial advisor, one, and kind of being open-minded to what they had to say and not just going ahead and executing what they thought or panicking. So this, in hindsight, did help a lot. As we all know that markets actually went up by 41% from their extreme fall of 60%. So recovery has been sharp.
Right. So, Vishal, is this what when we talk a lot about on this show, for instance, on planning, investing, and this is really that event that you were planning for and investing ahead for, sudden dislocation in life, in career, in jobs, and a sudden need for money, unfortunately for some people, even for health and medical reasons. So, has this, when you look back now, has this strategy been the right one of broadly investing steadily, staying invested?
Well, it certainly has. I think the foundation of any good financial plan is really to get both, emergency provisioning and risk management in place. And I think both of these have got completely tested in the last 3 months because there have been people who've lost income, who've got salary drops, or who are worried that they will see it happen as things open up because they're seeing some of their colleagues, friends go through that. So I think, the need to have a robust emergency or contingency fund has been well demonstrated because only people who had that in place already could actually be a little calmer because they knew that they didn't need the money tomorrow or day after tomorrow to support their families and the fees of children. The risk management piece has again got well tested because people have had to go through health situations. People have, if you've lost a job, you may have lost your health cover along with it. So if you had a robust independent health cover, you kind of did that. And most importantly, I think the overlay of the investment strategy and the ability to invest gradually, whether for the purpose of creating a health corpus on your own, whether for creating an emergency fund, or even for just your longer term goals, has kind of played out well so far. And the reason why I keep saying so far is because we need to keep in mind that we are still in the middle of the pandemic, and therefore what we see today may not be the end point, and we need to continue this journey. Some of us would have started off earlier, some of us will be starting off now, but I think this journey needs to continue.
Right. And Vishal, that's a very important and sobering point. So, we're talking about investing in equity funds, and both of you have already touched upon it. So tell me, Vishal, and I'll come to Deepali in a moment. So why invest in equity funds only? I mean, isn't this the kind of time when actually I should be not putting all my eggs into an equity basket?
Well, actually, the reality is that the belief that a lot of people have is that mutual funds are essentially equity vehicles, and therefore a lot of people correlate a mutual fund with an equity investment. To us, the way we look at it is an equity fund is one of the types of mutual funds that are available. Just like you can buy gold, you can buy fixed income equivalents, just like you can buy investments internationally. I think the mutual fund is only a vehicle for you to kind of buy diversified exposure. And very clearly, the last few months have also demonstrated that portfolios that are well diversified have actually been able to handle this volatility much better, because you've had equity go down and come up, but it's not come back up to where it was before the pandemic started. But you've had gold actually move up substantially. You've had fixed income do extremely well because interest rates have come down. So I think more and more one has found that one will need to clearly identify what's the financial plan and financial goal behind your investing strategy. What's the time frame for individual components of your money, and then allocate them to a debt mutual fund or an equity mutual fund or a gold mutual fund appropriately, rather than creating one big basket which chases the flavor of the month.
Right. So Deepali, what's your approach, strategy, and in the context of what we are going through right now when it comes to equities and equity funds?
So my approach is more universal. While at this point of time, one might want to, over the strategic overlay, do a little bit of higher allocation to equity tactically. My logic is very simple. If you have goals in excess of 7 years, long-term goals, please look at equity, because at the end of the day, for us to respect money or nurture it or to realize it's one of the highest forms of energy, you have to beat inflation and taxes. And the only option in that sense is equities. And mutual funds offer a beautiful risk-averse diversified portfolio managed transparently. So equity should definitely form a part of portfolio if you have any goals which are in excess of 7 years. That having said, it's not a cut and paste approach. It has to be customized to each and every individual's need. And as Vishal rightly said, asset allocation therefore becomes mandatory, and your financial goals need to be woven into the appropriate asset class. Right. And to just kind of hedge against this volatility, SIP or STP does make a lot of sense.
Right, but Deepali, the data seems to be showing that a lot of people have actually started investing directly in markets. Clearly, there are brave people out there who were not there earlier. And I mean, we are saying brave, we are not necessarily saying foolhardy. What would you be? I'm sure some of them are your clients because they've seen the big dip and maybe they had some funds lying around and they wanted to jump into the market and obviously benefit, and they have. So what are you telling them? What are you telling those who are in systematically invested plans and so on?
So genuinely, if you ask me, it's avoidable. If you don't have the acumen, investing directly in stocks is a little bit avoidable, because even if you end up choosing large cap stocks where the chances of going wrong is low, you might not be making use of the opportunity cost in terms of what should be the allocation of to which stock, when should I enter, when should I exit, which a MF guy or a MF fund manager does ably and at a very wafer thin cost. So if you ask me, so far so good. And I definitely agree it's a little brave. Whether it's bravery or bravado, only time will tell. But genuinely, it's avoidable. If you don't have the skill set to read balance sheets, analyze companies the way fund managers do, it's too much of a risk at too little saving of cost.
Right. Right. So, Vishal, how are you viewing this phenomenon, particularly that we've seen in the last maybe a couple of months, where more people have gone directly into equities?
So we think there are a few drivers of this. I think one is, the fact that people have had more time on their hands. A lot of people have been working from home. as compared to what they would do normally in any city. For example, they would clearly end up spending time commuting. They're not spending that time right now. So I think there is some element of time that has got created in their lives because their businesses and professional lives have got disrupted. And a lot of them are using this time to, indulge in some element of equity investing. Clearly, there are significant risks in this approach. Number one comes from the fact that there is a very wide dispersion of outcomes that happen within an index itself. And even if you go to the large names, one can see that, if you go back and look at the last 1, 2, 3 years, you will see that there are stocks that are up, more than 100% in that time frame, and there are stocks that are down, 70% in that time frame, even though you're in the larger names. And clearly, the ability to be able to, spend time and to get to the bottom of, how companies' finances are doing is tough for most people. In fact, we think that this is even tougher right now because what we're hearing from a lot of company managements is they're saying we don't have any ability for us to give you a future guidance. And therefore, the company themselves are telling you we are struggling with figuring out what to do in this environment. So what makes us confident as investors or advisors that we know with a crystal ball what's going to happen in the future? So I think it's very, very important for us to keep in mind that any investor has an extremely high level of specialization and skill in the field that he or she is, has studied in, has actually spent his career on, has actually got trained in. In comparison, a fund manager is doing, exactly that. He's skilled at that. He's paid to do that. He does that for a living.
Right.
And I think we need to distinguish, what we are wanting to do versus, what we should be doing. And therefore, can we use our time more constructively to actually future our own professional needs rather than trying to indulge in a stock market purchase and somehow believe that because in the last 3 months I have had success, now believe that I'm now, equipped enough to become the manager of my own money.
Right. So Deepali, strategy going forward. I mean, this we are where we are, and it is volatile times. So how are you, or how would you recommend getting into the market, or if you were in already and got out, maybe getting back in, or if you're in but not sufficiently, given what your resources are, how do you extend that?
See, I think we all are a little blindsided on how the market will behave in future. And we all get wiser in hindsight. So in such times, it's always better to trust a systematic transfer. If you have bulk money, put it in a mother fund or a source liquid fund, have it transferred maybe today rather than doing a 12-month systematic transfer. I would be inclined towards doing it in 6 months. So I would crunch that time to kind of use my dry gunpowder for investing in equities. That having said, I think that's the only tactical change I would do. Strategically, even at this time, the Lord and Master is your goal. I mean, you have to invest as per your goal. However lucrative the external environment looks, you have to actually look within. And only if you need equities in terms of your goals being long-term enough, please go for it. Otherwise, avoid. And mutual funds are the best route. Most versatile.
Right. So Vishal, suppose I do have a block of cash or money. Do I put all of that in the market now, because obviously it's still lower compared to what it was in January, or should I still stick to a systematic approach?
So I think for most investors, they'd be better off investing systematically, because I think there are these questions around how much of this rally is driven by liquidity and how valuations for companies are going to be going forward. And I think that's going to be an eternal debate, because there's no way to be able to understand how much of a gain of a particular index is driven by liquidity versus valuation. And I think for most investors, I think they're well off and well suited to figuring out that, if I do generate income on an ongoing basis, let me put a part of it away in a very disciplined manner. Similarly, if I have lump sums of money, let me not try to figure out, which is the best time to do it. Should I do it in 2 tranches? Should I do it in 3 tranches? I think those are all very speculative kind of outcomes, because the way we look at it is the true solution to the problem that we are facing today is going to come from a medical solution that gets found to the pandemic. And
Right.
I think we need to understand that and leave it there, saying that as and when that solution gets found, there will be a little more clarity. Till that clarity emerges, the only way to deal with it is to invest systematically and have the discipline to continue to do so.
Right. So discipline is important even at a time like this. While it might appear to you when you look at the numbers that the Sensex or the Nifty is off from its highs, of the big highs which we saw earlier this year. Okay, so obviously Deepali and Vishal, so this has clearly taught us this period that you need to invest or you need to have some emergency money on standby for most people. And how do you then, now that maybe some of us have got a root shock, how do we then pick up the pieces, so to speak, and build a more careful and thought out strategy? I know you've answered this question already in some ways, but if I were to now say, okay, here's the 3 things that we should do. And Deepali, let me begin with you. What should be, how do I restart or in a way, dedicate myself to equity and equity investing in funds?
Okay, so before I actually go to equity investing, since you mentioned the top 3 things to be done, first thing is have an adequate, when I say adequate, close to 6 months emergency fund or 6 months of expenses. Second is have an insurance for dependents, both junior and senior. That's not mandatory. If you have an investment portfolio which is large enough, insurance is not mandatory. Medical insurance is mandatory, whether your company sponsors or you sponsor for yourself and your dependents. So these are the top 3 things. And on building an equity portfolio, the way I look at it is, there is a phrase in Hindi, jab jago tab savera. When you realize you need to get going, you just have to get going. What has happened in the past is immaterial. So just get going, list down your goals, classify them as short, long, medium, and accordingly for your long-term goals in a SIP fashion, start investing in equity mutual funds. The only difference versus other non-pandemic times, please invest at least 10% more, because all of our expenses have genuinely gone down. So we might be in a position to invest 10 to 15% more. So just start building your portfolio through mutual funds, diversified, preferably, and multi-cap, large,
Right.
mid, everything.
Right. Okay, so Vishal, let's build on that. So, I mean, first of all, if you have any broader, cardinal principles, and secondly, what is the kind of portfolio, and looking at the kind of stocks that are likely to do well or will be stable in near term, in the near to medium term.
Because I'm just going to build on the equity question that you had in terms of what really do we want to ensure at this particular point. So I think one is. I think we need to understand that an equity strategy needs to have both an active and a passive component to it. I think, there has been this eternal debate that has been happening where, a lot of people say that, put all your money into actively managed equity mutual funds because the fund manager will outperform the index. And there's been an eternal debate, especially internationally, about passive investing where indexes or indices will always outperform the manager because of cost reasons. I think this jury is still out from an Indian context, though a lot of the data is starting to show that India is also starting to behave like international markets, where fund managers find it difficult to outperform indices. So I think very clearly the need to build both an index fund-based equity mutual fund portfolio and an actively managed mutual fund portfolio is very critical for investors who are starting off. The second thing that needs to get done is the need to understand that there are styles of investing that different managers bring to the table, which could be, for example, at the simplest level, growth styles and value styles. So growth styles typically chase, high growth businesses, and value style investing chases stocks that are undervalued or intrinsically valued lower than their fair value. And I think these two are very different approaches. And what a lot of investors need to do is when they're constructing their portfolio, they need to keep in mind that these two approaches will work differently at different points in time. It's very hard to be able to time your entry and exit out of these styles. So build both of them. And last but not the least, I think it's very, very critical for all equity investors to start thinking about how they build a component of their money internationally as well. I think a lot of times our asset allocation conversation is about equity, fixed income, and gold, while no one talks specifically about country risk that might come along with that. And therefore, for a lot of people who are diversified today, they have real estate in India, they have equity in India, they have gold in India, and they have fixed income in India. And therefore, if there is a challenge in India itself, then essentially all their wealth is at risk. So I would just strongly recommend to everyone that they need to start layering their India equity strategy with some element of international exposure.
Right. Okay. A couple of questions have come in, and Deepali, let me throw them to you. First is from Ruchi Kamble. She says, as much as I want to invest in equity funds, I have no idea how to start. What is the first step to investing in such funds?
The first step to investing in such funds goes via financial planner. Please go get hold of a financial planner. You are happy to read a lot of stuff if you want to know how to invest, where to invest, the type of investing, the active passive part, the large, mid, small growth value part. All of that is very good for you to read, but for a little bit of effectiveness, especially to manage your emotions in these times and a lot of such times which will come, your behavior is actually the key. It might be a good idea to approach a financial planner and let him guide you through the process.
Right. Right. Okay. Vishal, this is a question from Rajdeep Naik. I've just started investing. Do you think equity would be ideal for me, or should I begin with debt mutual funds?
So I think it's all driven by what is the investment horizon that Rajdeep has. I think if he's comfortable with putting money away for at least 7 to 10 years, then clearly equity is the asset class that one should build exposure to. The probability of a better outcome is much higher. But if the intent is to really go out there and create that emergency fund, ensure that if there is a job loss or an income situation that's well covered, then debt funds are going to be the place to look at.
Okay. Next question. Akhilesh Sarate asks, I already have a lump sum investment in equity mutual funds. Can I start an SIP in the same fund? Vishal?
Yes, I think it's ideal to do that as long as you have a fairly well diversified portfolio. I think the idea that you need to have 30 different schemes and keep chasing who's the best performer in the last 3 months, 6 months, 1 year, etc. I think doesn't really augur well. I think as long as you've been prudent with your mutual fund selection at the first stage and you track its performance and it's kind of doing reasonably well, I think it's a good idea to do an SIP so that you get the chance to add units at lower costs as well if you've ended up buying it higher earlier.
Right. Deepali, to you, Manish Sangvi asks, do you recommend a lump sum investment or an SIP? I mean, I know we covered this, but clearly people want to know.
Manish, any day I would prefer you do a STP. Looks like you have a lump sum amount to invest. For that, use a STP, and for your regular cash flows, as in inflows which you get, the surplus from that can go through SIP. And the most important thing for Manish and all others is, in terms of a compounding to work, equation to work in your favor, the most important thing is input. How much can you give as an input? Besides, obviously, the time you spend and the rate at which you invest. But given that all of us are talking equities here, rate at which we invest could have only marginal difference. But how much can you plow in and for how long can you stay put are the two most critical things.
Right. So, Vishal, as someone who's been in the markets for a long time, as both of you have been, Vishal, did you get a sense that the fund managers who are managing money were broadly in control in this period? Because we saw some of the wildest swings that we've seen in a long time, and maybe they were, for many they may have been seeing it for the first time. So in general, this is more a temperature question rather than a statistical or a data question. Are you confident, or were you confident that fund managers were in control of the situation?
Well, pretty much, because I think the way that we've looked at it is, the advantage that mutual fund managers have had, and that's played out in this environment, is access to information. And the more access to information you have, and the better data that you're using to make decisions, the more likely that you're going to take decisions which are superior. I think the jury's out on. A lot of these decisions will play out over the next 3 years, 5 years in various forms. But I would say that, the more information and the better understanding you have of the underlying businesses, which clearly a lot of fund managers have demonstrated, is what gives you confidence and the conviction to stay invested with mutual funds.
Right. And Deepali, the same question to you. You sleep, you go to sleep well, thinking that someone else is maybe having a sleepless night managing your money, but then that's the fund manager's problem, not yours. So is that something that you would continue to bet on?
Oh, yeah, big time. 8 out of 10 is what I would give. I think they've done a fairly good job. We need to do a job better of managing our emotions. Otherwise, pretty tic-tac.
Right. Wonderful. So thank you both for joining me. We've run out of time completely. And for those of you who haven't, do pick up Deepali's book, Why Greed is Great. It sounds good, and I hope to read it too. So thank you both. My first guests after a long and prolonged period of absence and lockdown. Wish you all the best, and your teams as well. And hope to meet you soon. Thank you very much.
Thanks,
Thank you very much. Pleasure being there.